Good afternoon, everyone, and welcome to TBR's quarterly U.S. and Canada Vendor Benchmark Review. My name is Allison Crawford, and I'll be your host for today's webinar. TBR's focus is to provide business research to accelerate our customers' success, and the information we'll be covering today comes directly from our 4Q12 U.S. and Canada Vendor Benchmark Report. This detailed report includes information on vendor strategies, geographic growth, business segments, and more. The information our networking and mobility team delivers is invaluable to any firm with plans to expand their footprint or to compete more effectively in the North American market. We're excited to present our findings and get your feedback on our analysis. Before I hand this over to Eric and Chris, there are a few action items I'd like to cover with you. First, we're recording today's session and posting it on our YouTube site, TBRI channel. We encourage you to visit this channel and watch this presentation or any of the others that we've posted. Second, we'd like to hear your opinions and thoughts on the materials we're presenting. Please send any questions or comments to the Q&A or chat function. Chris and Eric will address them at the end of the presentation. Or if you'd like to set up a client inquiry for more detailed discussion, please reach out to Eric and Chris directly at the end of the webinar to set up that discussion. Third, we'll send out the slides to everyone registered for today's webcast within 24 hours of the conclusion of the webinar. You can also find these slides, as well as other thought leadership pieces, webinar decks, and commentaries on SlideShare at www.slideshare.net/TBR_market_insight, and I will provide you with all the social media links at the end of the presentation. With that, let me introduce Research Analyst Eric Costa and Analyst Chris Antlitz from the Networking and Mobility team here at TBR. Eric is the primary author of the U.S. and Canada Benchmark, and has been integral in helping our clients better understand the dynamics in this market. Chris has been covering the telecom infrastructure services market for the past 5 years and guides the research on our TIS benchmark. Their unique perspectives on operator go-to-market metrics, OPEX, and Capex are helping our largest clients reduce risk and increase their opportunity. And with that, let me hand this over to Eric.
Thanks, Allison, and good morning, everyone. Before I discuss fourth quarter U.S. and Canada mobile operator benchmark results, I'm going to provide a brief overview of TBR's syndicated operator research, which includes quarterly reports and our benchmark. In the benchmark, we cover the top players in the U.S. and Canada, including Verizon, AT&T, and Sprint in the U.S., and Bell, Telus, and Rogers in Canada. In our syndicated reports, we provide a variety of figures, including both financial and operational metrics, which serve as indicators of an operator's business performance. We look at how operators are making money and where they are spending money. TBR syndicated operator reports detail both wireless and wireline performances, including operator strategy, financial performance, go-to-market analysis, and resource management. The U.S. and Canada mobile operator benchmark is the accumulation of TBR's quarterly operator research and compares the strategic initiatives and the financial and operational performance of 11 operators in North America and discusses industry trends. So moving on, I'll now discuss TBR's fourth quarter U.S. and Canada mobile operator benchmark. I'm going to begin by going over a brief overview of the 3 key themes I'm going to be discussing today. First, we're going to talk about Capex. I'm going to discuss where operator spending is headed. I'm going to touch on what new technologies are being invested in, take a closer look at the Tier 1 operators on a per-operator basis. And then I'm going to also touch on consolidation, as it doesn't directly impact Capex spend, but there are a bunch of major deals going on in the industry right now, and this will change how operators will invest in the future in Capex. Then we're going to move on to revenue, do a market overview, talk about the data and voice segments. And then within data, we're going to talk about the plans that are affecting data growth, and specifically shared data plans, unlimited data plans, and the new unsubsidized plans from T-Mobile. And then we're going to talk about the new data services that are stemming from the M2M segment. Finally, we're going to talk about connections. Connections are traditional smartphones and feature phones, plus the connected devices such as tablets, USBs, and netbooks, and any other M2M connections that from appliances to just utility connections. All that combined is the definition of connections. So the industry is shifting towards counting connections rather than subscribers. So we're going to talk about the business model changes here, and then we'll touch on connected devices and then subscribers from a prepaid and postpaid standpoint. So to start off with Capex, wireless Capex growth increased in 4Q12 due mostly to LTE deployments. AT&T and Verizon had the bulk of their deployments done in 2012, and now they're going to finish up in 2013. Therefore, Capex spending in 2014 is going to pretty much peak and then begin declining over the next 5-year forecast as LTE networks wrap up from the Tier 2 guys and the Tier 1 players. LTE is still going to be the bulk of Capex investment during this time, but there will be other spending items that the operators invest into. So in the fourth quarter, the leaders were AT&T and Verizon in terms of Capex volume, but this is expected as they're the largest operators in terms of revenue and subscribers. But despite having the lead there, Sprint and T-Mobile both increased Capex growth the most in the industry, and this is due to the beginning of their LTE network deployments, and the initial LTE network deployment costs a lot more resources in the beginning than towards the end of the deployment process. So spending past LTE is going to be on a number of items. First, LTE Advanced is the next progression in the cycle of LTE networks. It's a software upgrade, and the networks are already prepped for LTE. They're LTE Advanced ready already, so for an operator to upgrade to LTE Advanced, it's inexpensive compared to the initial build, which requires equipment on site built in. And the result is going to be increased network speed, network quality, and capacity for all the operators that move to this technology. And this will be happening in late 2013, early 2014. Small cells and Wi-Fi are also big areas that operators are investing into to boost capacity, especially in urban markets and other venues like arenas and stuff. The Tier 1s all have a specific small cell strategy in place. AT&T also has a very big Wi-Fi network with over 30,000 Wi-Fi hotspots nationwide. And then last, VoLTE is going to be, operators will start moving towards that in 2013 and into 2014, depending on the operator. It's going to reduce network costs and make networks much more efficient as the voice packets travel over the same network as the data packets. Moving on, operators are focusing a lot on spectrum acquisitions. Basically, spectrum is the most valuable asset for an operator, and they're battling over position for future network builds. So they're trying to acquire spectrum now that they can use over the next few years when they're deploying their networks. Operators can also get spectrum from refarming their own networks, whether it be 2G or 3G. And many of them are doing this, but this is a multi-year process to transition all of the subscribers off of that spectrum and then repurpose it for LTE. And all the U.S. Tier 1 operators have or are in the process of obtaining a significant amount of spectrum. For Verizon, they got the spectrum from the cable companies in 2012. AT&T made the acquisition of NextWave along with a lot of other smaller acquisitions, and they're using they will be using their WCS spectrum. T-Mobile is merging with Metro PCS, which I'll talk about in a little bit, and together they'll have a significant amount of spectrum. And then, of course, Sprint is in the process of trying to buy out Clearwire, but there's obviously a lot of hurdles around here I'll cover in a little bit. So touching on the Tier 1 U.S. operators specifically, starting with Verizon, Capex grew 56.2% year-to-year in 4Q12. And in 2013, the spend is going to increase through the first half of the year, but then the second half is going to start declining as Verizon wraps up its LTE spend, or LTE network deployment at about mid-year. At this point, they're going to cover about 100% of their 3G footprint. As of today, they released their 1Q13 earnings, and they already had 95% covered. Once they're done with this in the second half of 2013, Verizon's going to begin deploying additional LTE in their AWS bands, which is the spectrum that they acquired from Spectrum Co. And this will give supplemental coverage in a lot of their major markets. So finishing this network early by mid-year is going to give them an advantage over the competition. They already had the lead in LTE, and they've had it since the beginning of when they started deploying in December 2010. And they had, in the areas that they did not cover in LTE, they had CDMA, or 3G speeds, which are, in comparison, AT&T and T-Mobile have HSPA plus speeds, which are much faster. So now that Verizon will soon have its entire footprint covered in LTE, it's going to give it a huge advantage over network speeds. Verizon's also investing into small cells and LTE Advanced, like I talked about earlier. They're planning on starting LTE Advanced in late 2013 and into 2014. And then in the meantime, small cells are going to help increase capacity in their major markets. They're also refarming their 2G spectrum, but this is going to take multiple years to move all the subscribers off of this. And I think they announced 2020 or 2021 as the year that that'll be officially done. And finally, from a spectrum acquisition standpoint, they're trying to strengthen their position. They currently have the most spectrum in the market out of the Tier 1 operators. They made a bid for Clearwire this week, or for Clearwire's assets, rather. They want the spectrum licenses that Clearwire has in a lot of the major markets to help boost capacity for them. I'll speak about this in a little while in more detail. So moving on to AT&T, Capex increased 19.4% year to year. AT&T is going to wrap up LTE by the end of 2013, and they're going to have 250 markets live by the end of this summer, which is still significantly behind Verizon, who had 491 markets as of today. AT&T is going to use its extensive Wi-Fi network and small cell deployments I mentioned earlier to help boost capacity in its urban markets. AT&T has Project VIP, which by the end of 2014 is going to help AT&T increase its LTE network coverage to 300 million POPs. And the Project VIP is about $14 billion. $8 billion of this is going to go towards the wireless segment, and it's going specifically to LTE and small cell deployments. In 2012, AT&T had about 50 different spectrum purchases. Most of them were small. The big ones were Next Wave, like I mentioned earlier. I expect that to continue in 2013 with a lot of minor spectrum purchases, but also they may target other companies for acquisitions. But this is likely to happen outside the U.S. They've been rumored to be looking for a European operator for a few months now, and although I don't think that the Vodafone, the deal between Vodafone being bought out by Verizon and AT&T is going to happen, that AT&T still is looking elsewhere in Europe for a potential acquisition target. Moving on to Sprint, they had the highest Capex growth of over 130% year to year in 4Q12. Most of this was due to their network vision initiative. It's in phase 2, which is the investment phase. It's supposed to wrap up by the end of 2013, early 2014. It got a little behind its LTE target due to delays from vendors, which its original target was 250 million POPs. Now it's only going to hit 200 million by the end of the year. The network vision is also shutting down the remainder of the IDEN network during 2013, and this will help reduce a lot of operating expenses for Sprint and allow them not to have to operate 2 separate networks. In addition to LTE, they're going to complete the bulk of their multimodal equipment deployments by the end of 2013. So the future of Sprint's Capex past 2013 kind of hinges on the outcome of who's going to buy them out. As I'm sure everyone knows, Dish made a bid this week to outbid SoftBank by over $4 billion for the controlling interest in Sprint. Depending on who makes it out with with the actual purchase will depend on what happens. If Dish ends up buying Sprint, I don't think they're going to have enough money to invest into Sprint, as they're going to have to take on a lot more debt in order to get Sprint, and they already have not a very strong balance sheet. So that I don't think they'll be able to invest as much as SoftBank, who is known for pouring funds into its outside investments in order to quickly turn them around to get positive results in a timely manner. So we'll have to monitor this closely, and but I do believe that whoever ends up buying Sprint will also end up getting Clearwire. And then last, I'm going to talk about T-Mobile and Metro PCS. I'm grouping them together as I'm fairly certain that this merger will go through in the next couple months, especially after Deutsche Telekom sweetened the deal a few weeks ago. They're going to lead Capex growth in 2013, as they'll have the bulk of their, they just started deploying LTE, and they're going to have the bulk of their deployment over the next 9 months. And in addition, assuming these two companies merge together, they're going to have to integrate their networks together, as Metro PCS runs a CDMA network and T-Mobile runs an HSPA Plus network. So they're going to be able to combine LTE networks easily, but they're going to have to discontinue CDMA and switch those subscribers over to the LTE and HSPA Plus networks. Touching quickly on the Canadians, Rogers, Bell, and TELUS all will complete their network, LTE networks, along the similar time frames to the U.S. They have a much smaller scale, though. They're currently in the process in most of the urban markets of deploying. Rogers has over 60% coverage complete of the Canadian population, and the rest of them are going to complete in late 2013, early 2014. So I want to talk about consolidation quickly. I won't really focus much on Metro, PCS, and T-Mobile. I think basically that deal is going to go through, like I mentioned earlier. So I'm going to talk mostly about Sprint. On the one hand, Sprint's trying to buy Clearwire. They bid $2.92 a share. They need approval from SoftBank, though, or now I guess Dish, depending on who ends up buying them out, in order to go through with this purchase. But they definitely need this spectrum for their future network plans. So this is where Dish comes in. They bid $3.30 for Clearwire. They need the Sprint approval, though, for this to go through. So obviously Sprint's not going to give them approval to buy the company they're trying to purchase. So instead, they went bigger and decided to make a bid on Sprint. So the background here is Dish has a lot of spectrum that they've acquired over the last few years, and it comes with regulations from the FCC which say it has to deploy it over within a certain amount of time. So Dish has to deploy a network in its using its spectrum over the next few years, and it's a lot easier to purchase an operator with a network already built out than to try to build out a network in such a short time frame. So Dish wants to use Sprint as the way that they're going about justifying their higher bid over SoftBank is that they want to go use a quad play option and use Sprint's network in conjunction with its TV, internet, and voice bundles to try to sell a quad play service to all of its subscribers. Like I talked about earlier, Dish's balance sheet is fairly weak, and it's going to take on a lot more debt in order to make this a success. It kind of makes me doubt that this is going to be a short-term success. It's going to take time for them to invest in the Sprint's network where they don't have enough funds. So lastly, Verizon made a bid on Clearwire's spectrum licenses for $1 billion and $1.5 billion, or $1 to $1.5 billion. I don't think this is a realistic bid. I think that Verizon is basically just coming in to slow down any kind of deal that Sprint's going to get with Clearwire. I don't think the FCC would allow Verizon to obtain that much additional spectrum on top of its already market-leading spectrum holdings. But it's a win-win for Verizon, as I mean, they'll either end up with this spectrum if it was somehow approved, or they're going to end up slowing down Sprint in addition to in addition to the Dish bid and the SoftBank bid and their bid for Clearwire. All these deals are under review, and they just came out, and it's just it put Sprint in limbo. It's going to slow them down on their future network plans. They are not going to be able to use any of the spectrum from Clearwire or the funding from SoftBank until this is all figured out. So it kind of benefits AT&T, Verizon, and T-Mobile in the meantime. So I'm going to move on to the second topic now in revenue. Overall operator revenue is increasing in 4Q12 due mostly to data growth. I estimate that wireless revenue grew about 10% year to year in North America during the quarter. Both service revenue and equipment revenue is growing. Service revenue is expanding due to data revenue growth, while equipment revenue is growing due to record smartphone sales, especially in the fourth quarter. Data continues to make up a higher amount of revenue compared to the voice segment. Voice is going to continue to decline over the next coming quarters and years. It's on a steady terminal decline trend, whereas data is going to continue to increase, and it's soon going to overtake voice as the majority of service revenue. So data revenue is going to be driven by increased smartphone adoption. In 4Q12, AT&T and Verizon alone had 20 million smartphone sales, which is a lot higher than the year before. Data is also going to be driven by new plans, and the current plans out there, shared data plans, unlimited data plans, and unsubsidized plans. I'm going to talk about each one of those now. From shared data, AT&T and Verizon are the two U.S. guys that have shared data plans. The Canadians also have a form of their own shared data plans, and these lead to the highest data revenue growth, and they also lead to the highest postpaid net additions, especially in 4Q12. Verizon, they require their subscribers to move on to their Share Everything plans now, any new subscriber that joins Verizon, and they've had extreme success with that. They already have 30% of their subscriber base their postpaid subscriber base onto their Share Everything plans. This is helping spur device adoption with tablets, USBs, netbooks, etc. It's contributing to data revenue growth at a much faster pace compared to the other plans. Unlimited data plans for Sprint and T-Mobile, those are the two big guys there. They grow data revenue growth, but they definitely do it at a much slower pace compared to shared data plans, as the revenue is at a constant level. It's a short-term option for these operators. I don't think long-term these operators will be able to continue to offer unlimited data as the demand continues to rise. Sprint's going to be the one that holds out the longest. They're going to offer it for pretty much as long as they can until it becomes too much of an expense for them. But it's their only really key differentiator from AT&T and Verizon at this point. And then unsubsidized plans. T-Mobile's uncarrier strategy that they released recently basically the goal is to simplify their plans for their subscribers, where you basically pay full price for the device either upfront or over a contract period. Then you pay less expensive plans. But the problem is, will customers see it that way? I think it's going to end up hurting T-Mobile, or it definitely won't help them gain postpaid subscribers. It's going to basically limit the effectiveness of the iPhone, which is a huge deal that they finally got it. They need the iPhone as a retention tool, but now that it costs $500, whether it be $100 upfront and then a certain amount for the next 2 years, or the $500 upfront, I don't see too many customers just going after the iPhone now, and therefore they might still leave for another carrier, even though they'll probably pay more in the lifetime of the contract. In their mind, they don't want to pay more for the device up front. So this is really going to benefit the low-end devices for T-Mobile, and also the bring your own device plan that they have, where you can just bring your own iPhone from a different network, and then you could get a lot cheaper service. But as of selling new iPhones, it's definitely going to slow the operator's progress there. So then, talking about new data services that are coming out. These are coming mostly from the M2M segment that are made possible by the new LTE networks getting deployed. They're going to supplement existing data revenue past the smartphone. Basically, smartphone penetration is going to continue to increase. It's at about 65% for the Tier 1 guys in the U.S. in the fourth quarter. It's going to still increase for the next couple of years, but it's going to reach a point of saturation where revenue starts to data revenue growth is going to start to slow, and operators are going to use these new data services to basically supplement that data revenue and continue to propel it at a faster rate. These services are going to come from multiple verticals, including home automation, transportation, security, healthcare, utilities, mobile commerce, and wallet. There's a lot more verticals that I didn't name here that you'll see solutions come out over the next few years. Pretty much, it's in the operator's court, and they can come out with whatever this growing ecosystem of connected devices. Soon, you're going to pretty much be able to connect any kind of device, from a thermometer to a phone to a tablet to a appliance. Anything's going to be able to connect together over the network. So the possibilities are endless. It's just whether what the operators develop. It's obviously in its infant stages right now. I'd give it about at least 2 years to start taking off more. First, you have to get the users more used to these kind of services and introduced to them. You have to get the word out on all these new developing services, and then you definitely have to continue to develop the ecosystem and have a bigger portfolio of devices before the market takes off. Currently, AT&T is one of the leaders here. They have their Digital Life home automation service. This went live in March. It's going to continue going live in more markets, and I think it's going to pick up traction as it expands throughout the year into different markets. And they also have the connected car along with the rest of the Tier 1 operators. They're making a lot of alliances around car manufacturers and companies like OnStar that work with the car manufacturers on trying to connect these cars. The goal is within the next 2 years, all new cars are going to be connected together, and you're going to see a lot of new so basically, within the next 2 years, you're going to see all the new cars come out with the new.
Yeah, just to fill in what Eric's talking about on the connected car, we are seeing more activity here with the operators looking to leverage their existing wireless assets. And car is one of the areas that is a big opportunity for them. Some of the operators are working very closely with automakers, and they're looking to bring in such services. Let me just give you some examples of some of the types of services that you could start seeing in a car. Having video streaming from a cell tower to a car that's on the road that the kids are watching in the back seat. You can also have things where M2M is being leveraged for insurance tracking, so asset tracking for things like trucking, the trucking industry, transportation in general. There's multiple areas that operators are looking at and putting some money behind right now, and there's some very interesting and compelling solutions that we're expecting to really start taking off this year and the next few years.
Okay, so moving back, we're going to go on to the third theme, which is connections. So give another overview of the definition in case you missed it earlier. This is traditional phones and smartphones in addition to all connected devices like tablets and USBs, and then all other M2M connections, including all of the things we just talked about, whether it be the car or the appliances at home, the thermometers, all of that stuff. So the industry is starting to shift towards counting connections rather than just subscribers. It's definitely going to shift more in the coming few quarters as this becomes one of the leading drivers of data revenue. Operators are, Verizon is the leader with this right now. They're the first ones to move towards ARPA, which is average revenue per account. They also count connections rather than subscribers at this point, and they're going to be followed probably soon by AT&T, especially as they're one of the leaders in the M2M space. And then eventually the other Tier 1 guys and Tier 2 operators will follow suit as data revenue continues to grow over the next few quarters. So talking about connected device briefly, connected devices, many of these are going to be tied into the home automation connected car like I just talked about. They also include the traditional ones like netbooks and tablets. We're seeing a lot more net additions over the last couple of quarters due to shared data plans especially. They're making it very easy and affordable to connect to a wireless network, which is helping drive net additions there. And from a subscriber standpoint, overall subscribers increased in 4Q12 as postpaid outperformed prepaid yet again. This has been a trend that's been happening all throughout 2012, whereas before that, prepaid was actually outgaining postpaid back in 2011. So from a postpaid standpoint, smartphone sales are a major driver there. We had a record holiday season during the fourth quarter. Verizon stole the show with 9.8 million smartphone sales and 2.1 million postpaid net additions. In second place, AT&T came in at 780,000 net additions, but they had the largest smartphone sales at 10.2 million. So they were definitely the leaders in the postpaid market during the quarter. The laggards were Sprint and T-Mobile. Sprint continued to struggle mostly due to their IDEN sub-losses. That'll end in 2013, and they'll begin to start adding positive net additions. They actually did add positive CDMA and LTE subscribers during the fourth quarter, but they got outpaced by the IDEN losses. And then T-Mobile, they continue to struggle in postpaid. They didn't have an iPhone in the fourth quarter. Their image was struggling. They didn't have any key differentiators to help sell their to help attract subscribers. And now to combat that, they're going through their whole rebranding process. They have new unsubsidized plans we discussed, and they now have the iPhone, although I kind of talked how those two, I think they're going to kind of limit each other's success. But overall, smartphones are going to continue to play a major role in the postpaid segment. Smartphone penetration reached 65% for the Tier 1 guys in the fourth quarter. That's up from 54% in the fourth quarter of 2011. Sprint is a leader in smartphone penetration, but they have a much smaller scale, so it's a lot easier for them to get a higher number. Verizon ends up in fourth place at 58.1% during the quarter, but this actually puts them in best position for the future as they have the most potential going forward. They have the lowest penetration with this largest subscriber base, so they have a lot more money that they're going to be making from smartphone sales comparatively to Sprint. And from a prepaid position, we're looking at the prepaid segment. There's heavy competition. It's been limiting net additions over the year. The leaders are definitely Sprint and their multi-brand strategy, which includes Virgin Mobile, Boost Mobile, and Assurance Wireless. And then T-Mobile, Odd, and Metro PCS there. That combination is going to create a value play giant that's going to compete with Sprint for the lead. The laggards are the other Tier 1 players, such as AT&T and Verizon. They both sell higher priced services, it's a lot tougher to get net additions. Even though Verizon continues to post positive prepaid net additions, a lot of them are padded down with tablets and other non-traditional phones. So apples to apples, they're not doing as well as the other prepaid players. And then also Leap and Metro. Like I said, I moved Metro. We're not going to talk about them because they should be merging with T-Mobile, and then they're going to go from a laggard to a leader overnight. So talking about Leap, they're going to continue to struggle financially and with subscribers as they've not gained traction with their iPhone offering, as they've had the same issue where the iPhone's too expensive for a prepaid subscriber typically to attract too many people. So overall, prepaid is going to continue to struggle due to the heavy competition and also due to the postpaid success, which continues to draw subscribers to it. So that wraps up the third major theme. I'm now going to go briefly recap what we discussed. So we talked about Capex, talked about the spending habits, the impact on consolidation, and we did a deep dive on all the major operators. And then we discussed revenue, the growth in data revenue, how plans are increasing and stalling data revenue growth, and then the new data services stemming from the M2M segment. Finally, we discussed connections. We talked about the business model changes, and then connected devices and subscribers from a prepaid and postpaid segment.
Hi, everyone. This is Chris. So that concludes the presentation here for the operator benchmark. However, before we open it up for questions, I just want to highlight here a little bit about our research at TBR and what some of the areas that we're looking at very closely for our operator coverage. On this slide here, we have four main themes that we'll be talking about in our 1Q13 round of reports. LTE, spectrum and network modernization, these are two things that we're looking at very, very closely. We're doing extensive research into how much the operators are spending on Capex, how much they're allocating to different technology types, and what their modernization plans look like, and tracking their progress there, new markets covered, POPs covered, et cetera. The second thing we're looking at very closely is connected devices. As my colleague here, Eric, was talking about, connected devices includes everything from M2M to an iPad, other tablets, et cetera. We're looking at how many connections are coming onto these networks, what types of connections they are, and how much money are the operators making from these connections. So it's a different business model than the traditional subscription model that they do, where you have one subscriber, one account, one device that's on the network. Now you're going to have one subscriber, multiple devices on the network, and that's really changing the business models, and we are looking at that very closely. The third area that we're looking at is new data services, and that correlates with the new connected devices that are being onloaded to networks, because now that the business model is changing and it's becoming all about data, we're seeing a need for operators to invest and upgrade in their OSS, BSS systems to provision and bill for these new plans that they're coming out with. And that segues into plan pricing, shared data versus unlimited data. We're looking at ARPA now, so average revenue per account. As Eric said, there is a shift now in the industry from ARPU to ARPA, and that all correlates with the connections and the new data services plans that we're seeing in the marketplace. And really just getting an idea and getting a handle on how are these shifts panning out, who's outperforming and why. These are all areas that we're looking at very, very closely in our operator-specific reports, and also that information gets rolled up into our quarterly benchmark assessments. So with that, we'll open it up for questions.
Great. Thanks, Eric, and thanks, Chris. We're kind of running short on time. We've had a couple questions come through. We'll be able to answer one, possibly two. So the first question, if you do have other questions, please send them through. If we can't answer them on the live webcast, we will follow up with you shortly. Okay, guys, the first question we got was, do you think the prepaid market will continue to consolidate?
So I do believe that it is going to continue to consolidate due to the heavy competition. I'd say the next probably most likely target is going to be Leap due to their continued subscriber losses and weak financials. They're going to they could be bought by any one of the Tier 1 players, most likely Sprint or T-Mobile. I believe that T-Mobile and Metro PCS, that new entity, once they get settled in together, start integrating their networks together, they'll probably eventually take Leap under their umbrella and become it'll help them challenge Sprint for the lead for the value play subscribers in the prepaid market.
No. Okay. So the next question we had that came through is, what are your thoughts and reactions around Verizon's 1Q13 performance as they released results today?
So yes, I mentioned certain things during the presentation. Overall, Verizon's they reported strong numbers today. They reported a very good increase in margins, high net additions in postpaid. Like I said, they had lower net additions in prepaid, but they're not too much concerned with that. They're mostly focused on their share everything plans in the postpaid segment. They had strong smartphone sales. I think it was about 7.2 million during the quarter, and then they're rolling out LTE as fast as they can. They're set to complete it by pretty much sometime during the second quarter of 2013. They're at already 95% coverage at this point. So their main focus is on completing their LTE network, on their shared data plans, which is helping them to drive the increase in connections, connected devices, and just in the postpaid segment in general.
Okay. Looks like we have time for one more question, if you keep your answer brief, gentlemen. You spoke a lot about T-Mobile. What do you think other operators will do in reaction to their unsubsidized plans?
Okay. Well, I don't think they're going to follow suit with unsubsidized plans anytime soon. It's not a risk AT&T or Verizon are willing to take. I think they're going to see how it plays out for T-Mobile in the next few quarters. They're definitely interested in what's going to happen, but I don't see any of these players specifically having their own unsubsidized plans. However, Verizon did announce, I think it was earlier this week or last week, that they basically they're not allowing their subscribers to upgrade their devices with unsubsidized pricing anymore. So they did come up with this device payment plan, and this is going to help compete with T-Mobile's. Like I said, you can pay over the course of the contract for a device on T-Mobile's unsubsidized plans. So similarly, Verizon is allowing their subscribers to upgrade any phone over $350 on a financed plan over a 1-year period. So that's probably the closest you're going to see them going after these unsubsidized plans during at least the next year.
Okay, it looks like we're out of time. So I'd like to thank you, Eric and Chris, for your time today, and thanks for everyone who's on the phone. And if we didn't get to any of your questions, don't worry about that. The analyst will be following up with you directly. As promised here, all the social media links, you can follow Eric as well as TBR on Twitter at the handles listed here, as well as checking out our SlideShare and YouTube pages to get additional content around the telecom market. Before you sign off, I'd like to ask you to fill out the brief survey we have at the end of the presentation telling us how we did both in terms of content as well as presenter. We are using this feedback quarter to quarter to improve our presentations and make sure that we are delivering value to all of our clients. I'm going to leave the chat function open for another minute or two in case there's any follow-up questions or requests for conversations. If we don't talk to you guys this quarter, we look forward to speaking with you guys all again next quarter. Have a great afternoon.